What is going on? We are at another Tuesday Home Finance Hacks, and we are going to be talking about time value of money. Time value of money is the one thing that can be the difference maker for you when it comes into real estate. And the sooner that you get started along your real estate journey, the more that time can help you build and grow that wealth. So what we're diving into today is something we touched on last week. So we talked a little bit about how time is your advocate. Basically, time can work for you in real estate. And the reason is because of that appreciation that real estate has. So on average, and we touched on this a little bit last week, real estate appreciates at about 4% year over year on average. Obviously, there are some years where it's higher than that, some years where it's lower than that, but on average, over the last 60 plus years, we're looking at about 4% year over year appreciation. So with that being the case, what you could purchase today on a $400,000 home, on average, this time next year would be worth about $416,000. The year after that, it would be worth about $432,000. The year after that, it would be worth somewhere close to $450,000. So actually, it'd be worth more than that, about we're about $450,000. Yeah, so we're about a $450,000 or $50,000 difference between where you are right now and where you would be in about 3 years if you were to wait, let's say 3 years. So if you purchased that $400,000 house, that means within 3 years, you've got about $50,000 worth of equity in that home. That's $50,000 worth of wealth that you've generated, and you didn't have to work to get it. It just got to you because of the market. But if you have, let's say, a rental place, not yours that you own, but you're renting a property, and you have not purchased a home, you decide not to make that step toward purchasing a home, then you're in that position where you've missed out on that $50,000 worth of equity. And generally people think, okay, well, you know what, I just missed out on the 50,000, but when I do jump in, then I can make it back. Well, for one, you can never go back in time and make back on those missed opportunities, but two, not only have you missed out on that $50,000 worth of equity that you would have had you purchased 3 years sooner, you also now have a greater expense when you do purchase, because you're no longer purchasing a $400,000 home. You're going to be purchasing a $450,000 home. And if you're like, well, no, I'll just find a home that's still $400,000. Okay, well, that home that you find now that's $400,000, guess what? It would have been 3 years prior. Exactly. It would have been tens of thousands of dollars cheaper if you had purchased it 3 years prior. So regardless of where you are at, for the most part, you're going to be missing out on two fronts by waiting to jump into the housing market. One, that appreciation that you would have gained to help you grow that wealth, but two, that increase in the purchase price. And that increase in the purchase price shows up in a couple of different ways that it's costing you. One of the ways is that it's going to cost you more in taxes and insurance at that initial onset when you start purchasing a home. Another way, it's going to cost you more in closing costs. Your closing costs could potentially be a little bit higher because some of those closing costs are based on a percentage of the purchase price of the home. And so since you're purchasing a more expensive home now, or a home that was less expensive, a few years prior, but now it's more expensive, it could cost you that as well. It could also cost you how big of a home you could actually qualify for. Because let's say, for example, you could have purchased a $400,000 home that was 2,500 square feet, and you decided not to act on it, and you passed on it, that 4-bedroom 2.5-bath home, 2,500 square feet for $400,000. You decided to pass on it, and 3 years later that home's $50,000 more. Maybe you can qualify for the $50,000 more and you can go up to $450,000. Again, that's going to cost you more, but maybe you're like, okay, I'm gonna stay with my $400,000. But maybe 3 years from that point, now $400,000 won't get you the same 2,500 square feet on 4-bedroom 2.5-bath. Maybe that same thing only gets you 2,200 square feet on 4-bedroom 2.5-bath or 3-bedroom 2.5-bath. Maybe you can't qualify for the same size or the same quality of home that you were previously able to qualify for at that same price range just a few years prior. These are some of the things that people really don't calculate when they're like, I'm gonna sit on the fence and I'm gonna wait for interest rates. I'm gonna sit on the fence and I'm gonna wait for housing prices to come back down. While you're waiting, these are all of the calculations that you need to be making in terms of what it is that you're missing out on. You're missing out on that appreciation, yes, but you're also missing out on the lower cost when you purchase that home, because again, you're going to be paying more. You're missing out on how much home you could have afforded for that same price point. Maybe you have to go back in a price point now. Maybe you can't afford the 400,000. Maybe you can only afford a little bit less than that, or maybe you can afford more. But there's another key to this discussion that we're having tonight. In addition to all the stuff that people don't factor into what they're missing out on, another thing that they are missing out on is the affordability aspect starts to diminish the longer that you wait. And this is how that plays out. 4% is what we stated was the average appreciation of a home value. And this is over the last 60 plus years. So let's say this continues, 4% appreciation. Cool. Does your income that you earn increase at a minimum of 4% year over year? This is getting into the affordability aspect of it. If you could afford a $400,000 home today, 3 years from now, at a 4% appreciation, we're looking at somewhere closer to around $450,000. Could you afford that $450,000 home? That doesn't mean that your income had to increase $50,000. Maybe you only have to make, an extra $300 or $350 per month. But does your income increase another $350 per month? Maybe that's doable for you. Maybe it's not doable for you. But these are some of the things that you need to start thinking about. Is like, hey, is my income increasing enough for me to be able to afford another $50,000, in a purchasing power? Because a lot of people, housing has been outpacing their earning wages. So they're earning right here, and earnings might steadily be creeping up at maybe 1% or 2% increase year over year. Because as we know, wages don't increase to keep up with the cost of living in a lot of places. And so you've got that 1% increase, 2% increase maybe in that earnings that you're making, but then you've got 4% increase in the housing market. And that 4% that's constantly pulling away from your 2% and your 1% creates a gap that's widening in the housing market, meaning that the people who own a home, it's getting harder and harder for the people who don't own a home to jump over that chasm to get to becoming a homeowner. Because again, you've got that 4%, and that 4% is increasing at a faster rate with home prices than that 1 to 2% that a lot of people might be seeing in their employment increases. And so since your income is not increasing, or income increases, I should say, not employment, but income increases. Since your income is not increasing as quickly as home prices are, that's something that you really need to take advantage of in terms of trying to get into the housing market sooner rather than later, because the longer that you wait, the greater that gap becomes. And of course, you can always make changes in careers. You can always, get promotions, something that can jump your income up to another level. But a lot of people, that's not the case. A lot of people are taking a side move in their employment or in their jobs rather than taking a forward move. And it means that, they're working a job where they're happier. Maybe they're making the same money. Maybe they're making a little bit more money and they're happier, but they're not able to still afford, a whole lot more home. So these are some of the things you need to consider. You need to consider all of the things that you're missing out on when you're not taking advantage of the time value of money, meaning you're not getting into real estate early and holding it for the long term. So you're not growing that wealth. So you're missing out on appreciation, but you're also going to end up having to pay more in closing costs, paying more in taxes, paying more in insurance. Those are some of the costs that you're going to have up front. You might have to sacrifice more in how much home you can actually afford, because whereas you could have afforded a $400,000 home, maybe your income hasn't increased enough for you to be able to afford that same home, which is now $450,000. So now you have to decrease, what you wanted in a home to fit more within your budget, which is fine. But had you acted sooner, maybe you could have gotten what you really wanted and it would have been in your budget. So that's some of the things you need to know. But lastly, like we just said, you also need to factor in that gap, that widening gap that's growing. So one of the statistics that came out in National Association of Realtors actually reported this in an article, I believe. I can't remember the article date. It was earlier this year, though. That the average age of the first-time home buyer has been increasing. I think it's at about 38 years old now, being the average age of a first-time home buyer. A lot of first-time home buyers are in their mid-30s, their late 30s. It's not like decades ago or even the previous, one or two generations where people in their early 20s were purchasing homes, mid 20s purchasing homes. Now, home ownership has been something that many people have delayed, they've put off, but to their detriment, it's cost them because now homes are so much more expensive. But also, some of that putting off has been because of the economy. It's because you can't go out and buy a $80,000 home like you used to be able to do, maybe in the baby boomers age. So you know what? Some of those costs do play into that, but keep in mind that's not something that's shortening. That gap is widening. And it's my belief that it's going to continue to widen. It's going to continue to get harder and harder and harder until it gets to that point to where, you're not going to have as many people that are going to be able to make that jump into home ownership as easily. There's down payment assistance programs and things out there to help you. But at the end of the day, it's really just going to be you being able to afford that monthly mortgage payment. And as homes continue to appreciate, even if you can cover all the upfront costs, can you still afford a $2,500 a month mortgage payment, a $3,000 a month mortgage payment? How much of your income does that equate to? These are some of the questions you need to be asking yourself, in addition to, do I really want to continue waiting before purchasing a home, because it could end up costing me more than what I realized. So that's what I have for you. Thank you for taking the time to tune in. Fridays, Greatest Asset Community Podcast. We will be dropping another episode and then be right back here on Tuesday live for another episode of Home Finance Hacks. Till next time, take care. Be blessed.